Hey everyone, and welcome back to the channel. Today, we're diving deep into one of the most common, yet riskiest, mistakes investors make, putting too many of their eggs in one basket. We're talking about overconcentration. I know, it sounds a bit technical, but trust me, understanding this concept could be the single most important thing you do for your financial future. It's the difference between sleeping soundly at night and anxiously checking your phone every 5 minutes. So, grab a coffee, get comfortable, and let's talk about how to build a portfolio that's strong, resilient, and built for the long haul. So, what exactly is overconcentration? Imagine your entire investment portfolio the pizza. A well-diversified portfolio is like a supreme pizza. It has a bit of everything: pepperoni, mushrooms, olives, peppers. If you suddenly decide you don't like olives, it's no big deal. There are plenty of other delicious toppings to enjoy. But an overconcentrated portfolio is like a pizza with only one topping. Say, just anchovies. If you discover you hate anchovies, or the anchovy market suddenly collapses, well, your entire pizza is ruined. In investing terms, this means tying up a huge chunk of your money, say 20, 30, or even more than 50% in a single stock, a single industry, or a single type of asset. It feels exciting when that one thing is soaring, but it can be absolutely devastating when it falls. The allure of overconcentration is powerful, and I totally get it. We all hear those incredible stories, right? The person who invested their life savings in a tiny tech startup that became the next global giant, turning them into a millionaire overnight. These stories are like modern-day lottery wins. They create this intense fear of missing out, or FOMO. You see a stock like Tesla or Nvidia going on a crazy bull run, and you think, if I just put everything I have into this, I could be set for life. It's a tempting narrative. You start to believe you've found the one, the single investment that's guaranteed to succeed. This conviction can be blinding. It makes you ignore warning signs and dismiss the timeless wisdom of diversification as being too boring or slow. But for every one person who strikes gold, there are thousands who hit rock bottom, losing their hard-earned savings. The media just doesn't tell their stories as often. Let's look at some real-world cautionary tales. Remember Enron. In the early 2000s, it was an energy trading giant, a Wall Street darling. Many of its employees had their entire retirement savings, their 401ks invested in Enron stock. They believed in the company they worked for. When the stock was high, they felt like geniuses. But then, a massive accounting scandal was uncovered. The company collapsed, and its stock became worthless almost overnight. Thousands of loyal employees who had planned for a comfortable retirement lost everything. Their concentration in a single stock, their employer's stock, wiped them out completely. It's a heartbreaking example of how quickly a sure thing can unravel. And it's not just about scandals. Think about BlackBerry. For a time, they dominated the smartphone market. Their devices were everywhere. If you had invested heavily in BlackBerry, you would have felt brilliant. But then, the iPhone arrived, followed by Android. The entire industry shifted under BlackBerry's feet. They failed to adapt quickly enough, and their market share evaporated. The stock price plummeted, and investors who were all in on BlackBerry saw their portfolios decimated. This wasn't because of fraud. It was because of innovation and competition. No company, no matter how dominant it seems today, is immune to change. Overconcentrating your portfolio is essentially a bet that the future will look exactly like the present, and that's a bet that history has shown to be incredibly risky. So, how do we protect ourselves from this? The solution is beautifully simple in principle: diversification. But what does that actually mean in practice? The core rule of thumb that many financial advisors suggest is to limit any single investment to a small percentage of your overall portfolio. A common guideline is to not let any one stock make up more than 5% of your total investment value. Let's walk through how this works. Imagine you have that $100,000 portfolio. Instead of putting $50,000 into one exciting tech stock, you follow the 5% rule. You invest $5,000 in that tech stock. Now you still have $95,000 left. You can spread that remaining capital across at least 19 other investments. You could buy shares in a stable consumer goods company, a healthcare giant, a financial institution, an industrial manufacturer, and so on. You can also diversify beyond just stocks. You might put some money into bonds, which are generally less volatile than stocks. You could invest in real estate through a REIT, or real estate investment trust. You could even allocate a small portion to commodities like gold, or to international stocks to get exposure to different economies. Now, your portfolio is that supreme pizza we talked about earlier. What happens next? Let's play out the scenarios. Scenario A: your favorite tech stock, the one you invested $5,000 in, turns out to be a dud. The company makes a bad decision, a competitor outplays them, and the stock loses 80% of its value. Now, let's look at the alternative. Imagine you ignored the rule and put $50,000 into that same tech stock. When it drops 80%, your investment is now worth only $10,000. You've just lost $40,000. Your total portfolio has plummeted from $100,000 to $60,000. That is a 40% loss from a single bad decision. A loss of that magnitude is devastating. It can take years, even decades, to recover from that kind of hit, psychologically and financially. The 5% rule isn't about being timid, it's about being smart. It ensures that no single event, no single company's failure, can sink your entire ship. It allows you to stay in the game long enough for your good decisions to compound and pay off. A great way to achieve this diversification without having to handpick dozens of individual stocks is through index funds and ETFs, or exchange-traded funds. For example, an S&P 500 index fund lets you buy a tiny piece of the 500 largest companies in the U.S. with a single transaction. Instantly, you're diversified across multiple sectors of the economy. Your success is no longer tied to the fate of one company, but to the broad performance of American industry. This is the strategy championed by legendary investors like Warren Buffett for the average person. It's low cost, it's simple, and it automatically prevents you from being overconcentrated in any one name. It's the definition of not putting all your eggs in one basket. To wrap this all up, the temptation to go all in on what seems like a sure thing is a powerful human emotion. But in the world of investing, sure things are incredibly rare. Companies that seem invincible can falter. Industries that dominate today can be obsolete tomorrow. Building lasting wealth isn't about hitting one home run. It's about consistently getting on base and avoiding catastrophic strikeouts. By limiting any single investment to a small fraction of your portfolio, you are not being fearful, you are being strategic. You are building a resilient financial structure that can withstand shocks and stand the test of time. You're giving yourself the freedom to participate in the market's growth without exposing yourself to ruin. So take a look at your portfolio today. Are you a little too heavy in one spot? Is one position keeping you up at night? If so, it might be time to rebalance and spread the risk. Your future self will thank you for it. Thank you so much for watching today. I hope this was helpful. If you got any value from this video, please give it a thumbs up, it really helps the channel out. And if you haven't already, hit that subscribe button and ring the bell so you don't miss our future videos on building wealth and investing smarter. Stay safe, invest wisely, and I'll see you in the next one.